Make sure to claim your 4 free stocks with WebBull with the link down below. On May 8, 1886, Dr. John Pemberton served the world's first Coca Cola at Jacob's Pharmacy in Atlanta. From that one iconic drink, they've evolved into a total beverage company. If you had invested $40 into a single share of Coca Cola in 1919 during the IPO, you own 9,216 shares after all the stock splits over the years. This equates to $394,500 as of March 26, 2020. If you had reinvested dividends, your investment would be worth over $10 million. This represents a compound annual growth rate of 14.27% from 1919 to 2021. But after all this growth, is it still a good idea to invest in Coca Cola stock? Let's analyze the stock. First, business strategy and outlook. Coca Cola's ubiquity and brand resonance in the non-alcoholic beverage category has been going strong for over 130 years, and I see structural dynamics that will ensure this persists. Despite competing in a mature industry, the firm is adequately exposed, either directly or indirectly, to growth vectors, such as premium water and energy drinks. Moreover, we believe Coke will be able to continue extracting incremental value growth from the carbonated soft drink market. The runway for growth is supported by ample room for share gains as well as geographic tailwinds. I expect commercial drinks will become a larger portion of beverage consumption globally, and see the company executing against each of its market-specific strategies. In developed markets where Coke has firmly established the resonance of its brands, its strategies are geared toward profit growth driven by innovation. In developing markets where its trademarks are visible but competition is rife, differentiation and eventual migration into higher margin offerings is key. In emerging markets where the firm is less established, it is focused on driving volume growth even at the expense of modest margin dilution. I view these approaches as prudent and believe the decision to cull peripheral brands, going from 400 master brands to 200, will facilitate execution. Coke's future trajectory is not without risk, as it faces COVID-19 disruption, secular headwinds in terms of consumer sentiment, and well-capitalized rivals. Still, with a more aligned and technologically capable distribution system, digitization initiatives to drive engagement and operational efficiency, and vast financial resources, the firm is more than equipped to defend its turf. Ultimately, Coke's overarching goal is to put drinks in more hands in more places more quickly than any competitor. Now, let's talk about economic moat. I see numerous structural advantages that should allow Coca-Cola to extract economic rents from the markets in which it competes. At a high level, I believe there are characteristics endemic to the non-alcoholic beverage industry more generally, as well as Coca-Cola's specific positioning in this industry, that result in a competitively advantaged business. While the company is disproportionately exposed to beverage categories that are in secular decline in developed markets, I believe it has the brand equity to induce demand for reformulated variants of its most popular trademarks, the resources to reorient its portfolio toward drink categories more consistent with the consumer ethos, and the scale to fulfill these endeavors profitably. Moats in the beverage industry are typically predicated on some combination of cost advantage and intangible assets, and I view Coke as an archetype of these competitive dynamics. As it relates to cost advantages, scale is the primary contributor to this moat source, and the carbonated soft drink space is quite conducive. The industry is consolidated with the top 2 players, Coke and Pepsi, controlling close to 70% of global volume according to EUROMONITOR. At the same time, there is a confluence of relatively simple input costs, but ultimate ingredient formulations that result in distinct taste, combined with a relatively taste-sensitive core consumer. The consequence of these dynamics is that, while market share has and will oscillate, both companies benefit from a core patron base. There is little incentive to price irrationally because, for example, a consumer who prefers Coke's taste will continue to do so regardless of Pepsi's price, which severely limits the potential marginal benefit for either company to materially underprice its products. Ultimately, this ensures that they garner enough volume to achieve scale efficiencies. Coca Cola enjoys leading volume in most of its markets, which contributes to its cost advantage. However, the largest pillar underpinning this moat source for Coke is its ability to position itself at an area of the beverage supply chain that is structurally lower cost. Most of Coke's trademark beverages that are ultimately bought by consumers are not packaged and distributed by the company itself. Instead, Coke focuses its operations on producing the concentrate or syrup for these beverages and ships these mixtures to bottlers for processing, packaging, and distribution. From a manufacturing standpoint, concentrate operations are markedly less capital-intensive and require less labor and overhead relative to finished product operations, which require specialized canning and bottling production lines that are typically not interchangeable across products or package sizes. To illustrate, consider that Coca-Cola's capacity for its concentrate operations, which account for over 80% of total unit case volume, is met using roughly 30 manufacturing facilities, whereas the firm's finished product operations, accounting for less than 20% of unit cases, require close to 90 facilities. Additionally, concentrate operations benefit from a more homogeneous manufacturing process across concentrate variants, as well as less volatile raw material procurement. Coke's leading volume, in conjunction with its selective positioning along the supply chain, leads to attractive unit economics that manifest through two primary dimensions: the firm's ability to leverage fixed costs and its ability to reduce variable costs through more efficient procurement. The firm's lower cost of goods sold per unit case supports my conviction. Ultimately, Coca-Cola boasts best-of-breed gross margins above 60%, which to us represent the best evidence of its manufacturing cost advantage. Additionally, while main competitor Pepsi brings in approximately twice the revenue that Coca-Cola does, its workforce is roughly 4 times the size. While this dissonance is partly reflected in the manufacturing processes and Coke's superior gross margins, it is also reflected in the administrative and corporate side of the business. Coke's more focused portfolio and superior unit production beget more meaningful leverage as it relates to costs for operational personnel. While Pepsi's broader portfolio and integrated business model yield material marketing and distribution synergies, in aggregate, the business still has less advantage and an inferior cost structure relative to Coke. Corroborating this dynamic are Coca-Cola's superior operating margins in the high 20s versus Pepsi's in the mid-teens. Regarding intangible assets, strong brands are the primary moat source in beverages. I see numerous attributes in the non-alcoholic ready-to-drink market that lend themselves to brand differentiation. These include conspicuous consumption in various on-trade contexts and taste sensitivity among many core customer cohorts. Additionally, private label penetration remains relatively low in certain categories such as carbonated soft drinks, and ongoing premiumization trends among soft drinks more generally should further insulate leading brands. Coke boasts an appreciably above-average portfolio of brands. The Coca-Cola trademark, more so than any other beverage or even broader consumer packaged good brand, has achieved almost totemic status in most markets. In addition to Coca-Cola trademarks such as Red Coke, Diet Coke, and Coke Zero Sugar, the company also owns Fanta and Sprite. All 5 of these brands are in the top 10 of the soft drink category on both a volume and value basis, with Red Coke the clear leader with 18% market share, double that of number 2 Pepsi according to Beverage Digest. The firm is also the preeminent player in juices with 11% market share globally, with Minute Maid and its Latin American Del Valle brand, as well as premium water through Glasso smartwater. Overall, Coca-Cola has leading market share across the non-alcoholic ready-to-drink, carbonated soft drink, and non-carbonated soft drink categories globally according to EUROMONITOR. The same holds true in the US. While the firm's leading market share supports its brand intangible assets, there is also compelling evidence that Coke, along with its rival Pepsi, has historically been a price leader in the non-alcoholic ready-to-drink industry. A recent illustration can be found in Japan, where the Coca-Cola system implemented a broad-based price increase that was eventually followed by its competitors. While premiums are dynamic and channel-dependent, I think Coke's capacity to raise prices with the confidence that competitors will follow suit speaks to the brand's strong industry positioning. Additionally, both Coca Cola and Pepsi consistently appear in surveys highlighting the most favored brands among fast-moving consumer packaged goods. Beverages account for over 20% of normalized food and grocery sales in North America based on EUROMONITOR data. In turn, retailers rely on Coca Cola's stable of high-velocity brands to drive foot traffic and/or inventory turnover, as well as exchange insights with the firm on strategies to increase overall category value. I assume that in an era where competitive differentiation is increasingly driven by technology-enabled analytics and algorithms, the data feedback loop that these retail relationships engender will perpetuate Coke's advantage. Unlike the alcoholic beverage industry, there are no laws mandating distribution to customers through an intermediary, which makes the non-alcoholic industry more. Profit drivers. Analysts' gross model margins reaching close to 63% in 2025 versus 59% in 2020. Gross margins have taken a hit recently due to the consolidation of various finished goods businesses, like Fairlife and bottlers in Africa, as well as cost deleverage from COVID-19 disruption. Still, analysts model gradual improvement, driven by better cost absorption and procurement benefits as the firm gains further scale in non-carbonates, supply chain, and operating efficiencies, driven by the company's technology-centered productivity initiatives, and improving unit economics in the bottling investments. These factors, combined with more disciplined marketing and fewer one-time charges, should also allow operating margins to widen from 27.3% in 2020 to over 32% in 2025. Risk and uncertainty. There are many risks to Coke's competitive positioning. We believe one of the more salient is the secular decline in carbonated soft drinks due to heightened social awareness around the potential health impacts. Though this is still a nuanced phenomenon and there are some markets where healthier consumption has been growing, the firm's aggregate exposure to this category is a risk that will need to be managed. Potential operational struggles among Coke's bottlers could also pose a challenge. The company's strategy does not entail owning bottlers in perpetuity, and Coke currently owns very few bottling operations. Still, Coke's reliance on its bottlers for execution is incontrovertible, and as a result, the firm not only commits to providing resources, but also to buy outright underperforming bottlers. To the extent that the firm must bring troubled assets onto its balance sheet, this could have adverse effects on cash flow. Finally, the increasingly viral nature of the media creates omnipresent risk in the form of potential brand degradation, and this is quite acute for most corporations. We believe these risks become near existential for the most consumer-oriented firms that rely on brand resonance most heavily. Well, that's it for today's video. If you enjoyed this video or learned something, please smash the like button and subscribe to our channel. It really helps us a lot. Thanks.